In order for an income to be taxable in Malaysia, you have to follow these 3 rules. Remitted. So when you're talking about remitted, please remember your remittance rule says that the income derived overseas. That means you got the income from an overseas source. You got that income from an overseas source. Guys, oh my God. Whoever is logged in, can you please log out? You're not allowed to be logged in. There is no hybrid classes anymore. Please log off. I will sincerely mark both of you all absent. Huh? You guys don't know how to be smart, do you all? Don't do such things. All right. Income derived outside Malaysia. Income derived outside. That means the source is outside Malaysia. Example, rental. Your property is outside Malaysia. You're renting it out. You're getting rental income. All right. Now, this rental income, you remit it back. The moment you get an income outside Malaysia, send it back to Malaysia, you're automatically subjected to Malaysian tax. That's what the remittance rule under Section 3 means. All right? You send it back to Malaysia, you automatically get taxed in Malaysia. Okay? Now, if you get say you got a property in Australia, you rent it out in Australia, you keep the money in Australia, you're not taxed in Malaysia because you did not send it back. But if you send back the money to Malaysia, you will be taxed in Malaysia because it's a rental income, it's a taxable income in Malaysia. All right? Now, the second one on Section 3 is accrued. Accrued. Now, the accrued thing here says that the moment the taxpayer has the right to the money, that amount of money becomes taxable in Malaysia. Meaning that if I sell you something in credit, I sell you something on 1st January 2023, but you pay me on 31st December, sorry, you pay me on 1st January 2024, that amount is taxable in 2023, not 2024. All right? Sale made 1st January 2023, payment received 1st January 2024. Here, amount taxed in 2023. Why? Because ownership has transferred in 2023. I now have the right to demand the payment from you at any point of time. All right? So it's not when you pay that you get taxed, it's when you make the sale. The sale was made in 2023, so you are taxed in 2023. So that's what the accrual basis means. All right? The next one is derived. Your derivation rule. Derived. Derived means the moment you have got the right, or the moment you have made that income, the moment you have made that income. So when you're talking about derived income, see, I'm very careful here. I'm not using the word earn. I am not using the word earn, because derived does not only mean you have earned the income. Derived means the moment you have got the income. The moment you have got the income. All right? So under derived, you have active income, and you have got passive income. That's why I do not use the word earn. Now, when you talk about active income, here you are putting an effort to get that income. You put in an effort to get an income. For example, your salary. If I don't come to work, I stay at home and sleep 3/4 of the time, do you think my company is going to pay me salary? They say, it's okay, now mind, you stay at home and sleep all the while. No need some time only. Right? So I need to come in. I need to teach you all. Sorry, I need to educate you all. All right? In order to get this income. Now, if I have a shop, I open my shop in the morning, go back home, sleep, evening come close the shop. Do you think I'm going to get any profit? Not. Most likely people are going to come and just steal my things. I'll make losses instead of profit. Correct? So I need to be there. I need to put an effort to make the sales. So that's what active income means. That's what active income means. Now, passive income. Passive income is where you do not need to put an effort to get the income. You do not need to put any effort to get the income. All right? Example, your interest. You put the money in the bank, you can sleep 24 hours. Don't need even to step out of your house. End of the month, end of the year, your interest is coming into your account. All right? You don't need to go to the bank, stand in front of the bank manager's office, put in my interest already. Put in my interest already. No need to do anything. No need to put any effort. Interest will come to you. Dividend. All right? You buy shares, you keep the shares. You don't even need to think about it. The dividend will come to your house. It will be posted to your house. So this is known as passive income. That's why you do not use the word earn, you use the word derived. The moment you get the income, or the moment you have the right to that income, it becomes taxable. Do you all understand? All right. So you guys studied under tax 1, again under tax 2. Your sources of taxable income is under section 4. I will go through this with you all shortly. It's under section 4. So you have section 4, A, B, C, D, E, F. All right, section 4, A to F. Section 4, subsection A, up to subsection F. That is your sources of income. So if your income falls under any one of this source, it automatically becomes taxable. Becomes a taxable income, which means that you would be subjected to tax. All right? Do you understand? Okay, now your second category of income is non-taxable income. The second category of income is your non-taxable income. So these are income not subjected to income tax. In Malaysia. All right, this is income not subjected to tax in Malaysia. So this income is known as out of scope of your Income Tax Act 1967. Out of scope of Malaysian Income Tax Act 1967. That means you are not within that scope. All right. Now, what is non-taxable income? That means no matter how much of money you get from this, you will not be subjected to tax. All right. Inland Revenue cannot capture you. So, the first thing is your capital gains. Anything that is capital gain, as at today, this very point of time when I'm talking to you, capital gains are not taxable in Malaysia, except for property, but that's under RPGT. It's not under your income tax. It's under RPGT. But come next year, I cannot guarantee you this. Budget 2023, they already said they are going to introduce capital gains tax. It will not be under your income tax. It will be another act altogether. All right? Or they may amend your income tax to tax capital gains. We don't know, but capital gains tax will be introduced very, very soon. So at this point of time, at this very moment, capital gains are not taxable. All right? Gifts. You get ang pao for Chinese New Year. That ang pao is a gift. It's not taxable. Your parents throw you a 21st birthday party. You get money. Lots of people, Malaysians have this habit. I don't know why. They give money a lot. All right? So that money is not taxable. You have a wedding. Make sure you remind to invite me. Huh? You get money for your wedding. Not taxable. All these are gifts. All right? So gifts are not taxable. So under gifts, you have your ang paos. You have allowances. Now, I'm working, so I give an allowance back to my parents. The allowance that my parents receive is not taxable because it's a gift from me to them. All right? So allowance from parents to children or children to parents are not taxable. All right? Guardians to their child care or whoever is not taxable. Now, windfall. Windfall is any winnings from luck. That means you do not put an effort to get these winnings. You buy lottery ticket, you win. Not taxable. All right? You buy 4D, you win. Not taxable. You go for a beauty competition, you win. Not taxable. All right, I will come back to this shortly because there is a clause in the Income Tax Act. As long as it's windfall, that means you did not put an effort, it's luck. You win it, it's not taxable. All right? Now, bonus shares. You receive bonus shares, you sell bonus shares. Either way, you sell bonus shares is also capital gain, not taxable. All right? Distribution of assets in liquidation not taxable. It's considered a capital distribution. All right? So these are things that is out of the Income Tax Act. So if you get a gain from this, it is not taxable. All right, guys? Now, you have the next source of income. What is known as your exempt income. Please remember, non-taxable income and exempt income, two different things. Now, for exempt income, please remember this income falls under Section 3 definition. Remember, we studied the Section 3 definition. We are saying that any income taxable in Malaysia is under Section 3. Any income taxable in Malaysia is subjected under Section 3. Now, the exempt income is a Section 3 income. Which means it is taxable in Malaysia. Whatever income under this is taxable in Malaysia. But it's exempted from tax. The key word here is exempted from tax. Number of people, not only students, sometimes you speak to people outside there, you say dividend, dividend not taxable what? Very wrong, guys. Very, very wrong. Dividend is a taxable income. It does fall under Section 3, but it is exempted from tax. That means I'm giving you an exemption. You do not need to pay tax. It does not mean it's not a taxable income. It is a taxable income. The only thing is it's been exempted from tax. So do not get yourself confused. Non-taxable income, income that can never ever be subjected to tax. Never. Exempt income, at any point of time, I remove the exemption order, this income will now become taxable. Understand that. All right. So exempt income are taxable income that are exempted from tax at this point of time. Okay. Now, what do I mean when I said they are exempt from tax? The most famous one is your foreign income. I'm very, very sure that you guys in tax 1 kept on going back to this. Para 28, Schedule 6. Any foreign income earned overseas, sent back to Malaysia, for now, not taxable. Understand or not? That's Para 28. It's exempted from tax. It's exempted from tax. But please remember, Para 28 for individuals only applicable until 2026. After 2026, Para 28 Schedule 6 is not going to be applicable, which means that you take income out, you get income outside Malaysia, remit it back to Malaysia, you are going to be subjected to tax under Section 3. This is what I mean, exempt income. If I take off the exemption, you get tax. If I take off the exemption, you get tax. All right? So it's a taxable income. It is a taxable income, exempted. Now, please remember, foreign income for individuals is 2026. For companies, only dividend income is now exempted. Any other income earned overseas, remitted to Malaysia for companies is no longer exempted. Is no longer exempted. So they go back to Section 3, becoming a taxable income. All right? Your next income that is exempted, your single tier dividend. Again, guys, if you look at your Section 4C, dividend is a taxable income. For now, it is exempted. It is exempted, so you don't really need to pay tax on it. All right? Other exempted income. So the thing that you need to find to understand about this is that your exempt income, you need to understand your exempt income is a taxable, it's a taxable income at a tax rate of 0%. It's not a non-taxable income, it's a taxable income, but your tax rate is 0%. So that's why you do not pay tax, because it's exempted. Understand that. All right? So other exempt income would include your exempt income from incentives. Remember your pioneer status. Investment tax allowances. Your reinvestment allowances. Where 70% is exempted from tax. Remember, guys? All this, you have your 70% exemption. Okay. Then finally, you have your shipping income. Where 70% is exempted. All right, the shipping income where 70% is exempted. So guys, you really need to know to differentiate between taxable income, non-taxable income, and exempt income. All right. Now, in order for you to be able to answer questions that is based on this topic, you need to understand that. That is your basic understanding. Now, this is just a revision. Sources of income. Section 4A. Under your section 4A, you have your business income. Section 4A is your business income. All right. Now, for section 4A, you do know that your guideline to determine business adventure is your badges of trade. I take it that you guys are very familiar with your badges of trade. Now, guys, I've given you a summary in your tax 3 slides. I've also uploaded your tax 1 slides that gives you detailed explanation of badges of trade. Remember, badges of trade is not a law. It's not part of the act. You open your income tax act, you will never see badges of trade in there. Badges of trade is a guideline used by Inland Revenue as well as the courts to determine if a trade exists. So please do not go and tell people badges of trade is a law, you have to follow. It's not the law. All right? Wages or trade is not the law. Please understand that. So when you're talking about business income, please remember business income includes manufacturing, it includes retail or trading, it includes professional. So if you are an auditor, you're a doctor, you're a lawyer, you're still carrying on business. All right? You're offering professional services. Vocational. A lot of people in Malaysia do tailoring, tuition. They say, I'm not doing a business one. They are. It includes, it's under vocational. All right? So when you're talking about section 4A, anything like this includes under 4A. Then you have section 4B. Which is employment. Four B is employment income. So under employment income, remember for employment income to exist, master servant relationship must exist. All right. If master servant relationship does not exist, employment income cannot be established. Then you have 4C. So under 4C, you have dividend. Please remember dividend for now, if it's for single tier. Single tier is only for companies registered in Bursa Malaysia. That means only companies not registered, not for companies, even though it's registered or not registered in Bursa Malaysia, for companies giving single tier dividend, it's exempted. Other dividends, dividends from unit trust, taxable. So only single tier dividend is exempted. Other dividends are taxable. Other dividends is taxable. Please remember that. Interest. There is a certain category of exempt interest. All right? It is taxable unless specifically exempted. Unless specifically exempted. It's in your tax 1 slides. I will upload it for you. All right? There are certain categories of interest which is exempted from tax. The rest of it is taxable. All right? 4D, royalty, rental, all right? Now, for all 4D income, you have the ability to minus your expenses. So the income is subjected to after deducting allowable expenses. Now, guys, you need to understand this because when you do tax planning, you need to understand whether an income is taxable, what is the taxable amount. And finally, you have 4E and 4F. Don't blame me, it's not my fault. People who did people who did the Income Tax Act was very bored with life. 4E is your annuity. You guys studied this word annuity under tax 2, I think. Pension. All this is taxable. All right. And 4F, see, they're very smart. 4F is anything that is not under 4A to 4E falls under 4F. So it's any income. The key word here is income, guys. Any income not under 4A to 4E would fall under here. So under 4F, you've got casual income. So everything under casual income, you're captured under anything and everything under casual income. So this would mean commission, one-time transactions, introducers, fees, although it may not be cash. For example, I introduce my brother to buy your house. So end of the day, you and my brother deal with each other. He buys the house. You're so thankful to me. You come and present me a watch. That watch will fall under 4F. Because you gave it to me because I introduced my brother. So although it may not be cash, it may be in kind, it can still fall under 4F. All right, guys? Okay, take a 10 minutes break and come back. Yes.
Just now the tutorial class was late and I didn't scan the QR.
Send me a message in Teams.
Okay, thank you.
Yes.
I want to ask the gift right is non-taxable income,
Mm.
but it's only not related to business. Let's talk about the example just now the watch for the referral. If they can argue that it was a gift and oh,
Okay. My question to you is, why did you give me the gift?
because when he come to see my house and then we talk very nice and then I think he's a nice person so we be friend and then I want to give
Yeah, because no. See, my brother and you had a deal. But why did you give me the gift? You gave me the gift because I introduced my brother to you. Correct or not?
Yes.
If I did not introduce my brother to you and you did not sell your house, would you give me the gift? Correct or
No,
not?
yeah.
So the purpose the gift was given was because of the sale of the house. That's why it falls under 4F. Now, if you come for my birthday and you give me a gift, then it's a different thing. You gave me a gift because I'm your friend. Understand or not? So you need to be smart. So if you want to give me a gift, because I introduced that house, come during my birthday.
So if like okay you introduce the house or have a, like the person bought a new house have an open house and then the person go there and give a gift
That one is not.
that's untaxable.
Understand or not?
Understand.
The reason behind the gift is what they will examine. Right?
All right, thank you, Miss.
Okay.
When it comes to the when you stated single tier dividend is exempted, right? And then you specified other dividend, unsingle tier dividends technically comprising of the dividends they want to issue out towards their shareholders.
See, only single tier dividend, which is issued by companies, fall under single tier dividend.
Or that specifically mentioned.
Right. No, single tier dividend, if you look at what single tier dividend is, it's actually distribution of profit by companies.
Company profit distribution.
Right. The reason why single tier dividend was introduced was because company suffers tax at company level, and based on that profit that they have paid tax, they're distributing to you. So this it doesn't make sense for you to actually pay tax again
So
because I already paid tax.
So it's basically tax. It's basically other company shares that they're holding that they receive dividends from?
Even if you are a shareholder holding company shares, the company would have already paid tax before they distribute dividends to you.
Yes, correct.
Right.
That's why you consider those
Single tier dividends. Like for unit trust dividends are not considered under single tier dividends.
Single tier dividends are specifically for
Companies.
for-profit companies.
For companies.
For
It's just
companies.
I wouldn't say profit companies.
But wouldn't you call unit trust companies as well?
They fall under a different category. They do not fall. Their dividends.
Okay.
Unit trusts, REITs, business trusts, all these do not fall under companies registered
So
under that category.
So, if I want to broadly say it, that means only basically all companies are technically single tier dividends for the exceptions that are those specific companies that are under specific rules.
See, even companies, you have to understand, they have single tier dividend and they've got exempt dividend. So that's why you need to understand when we say single tier dividend, it's only single tier dividend is. So if a company is not declaring single tier dividend, then the exemption doesn't exist. So that's why I do not say it's profitable companies or it's company declaring single tier dividends.
Only if they declare it as a single tier dividend. But how do they classify something as single tier dividend?
You have to understand the basic of a single tier dividend. All right, and that's a class all by itself.
The other one is also an entire class.
Yeah, you would have studied that under text 2, I think. Come see me when you're free. I will explain to you what is single tier dividend. I can't actually explain to you during their class time. All right. So basically, single tier dividends are exempted from tax. Either the single tier dividends, if it specifically does not say single tier dividends, then it's not exempted from tax. Exempt dividends are also exempted from tax.
Exempt tax, right, specifically mentions like it's meant to target things that the government in the short term decides that it is okay to not be charged.
Right, because there's an exemption order for it. So the moment the exemption order is lifted, it goes back to the original.
No, it's kind of like a government relief sign.
Right.
So you call government relief exempted.
No.
Sort of.
There are like certain times, from time to time, just like a public rulings, government comes out with exemption orders. All right. So it's an action to the act that this exemption order will be valid from this time to this time. So under each budget, you will see if there is an extension to the exemption.
Yes, that one.
Right.
So the exempted tax is effectively the government's means of showing
that I'm giving you a temporary relief from paying tax.
But because they are not instated directly in, like they are not amendments to the tax act itself, they are considered exempted. Even though they can be like 10 to 20 years down the line.
Yes, like single tier dividend has been in fact from 2014.
Oh, but they don't want to write it in the textbook because they can. So
right,
they
because
can,
at any point in time I want to remove it, I can remove
so
it.
that they can remove it.
Right.
All right, guys, let's get started. Not 10 minutes here, dah. Not 10 minutes here, dah. Another 2 more minutes, dah. Nah. Okay, while waiting for the 2 minutes, midterm is this Thursday, don't forget. I will put up the in the Webull which tutorial class is. We have 3 venues. So which tutorial class to sit at which venue? I will put it up for y'all so that y'all can go to the right venue. All right. Someone told me that their class finishes at 6. Who is it? Is there someone from here? Anyone whose tutorial classes finish at 6 or lecture class finish at 6 that day? 5:30. So it's fine now. We start at 6 to 7:30. Yeah. All right. So no need to bring any papers to write. There is allocation for you all to answer your questions in the question paper itself. So no need to bring foolscap paper, but please bring pens. Oh, you guys can laugh. You know how many times during a midterm they put up their hand. I said, what? Can I borrow her pen? And then she's there like. So please bring your stationeries. Pen, pencil, eraser, and most importantly, stapler. Please bring your staplers. All right? Send me a message. All right, so please bring your stationeries. Your handphones will not be allowed with you all during the exam. So make sure when you come in, put your handphones in your bags. Don't say one handphone in the bag, one handphone in my pocket. All right, no handphones, no smart watches, please. All right. If you get caught, don't blame me if I take away your paper. All right, so let's be honest with everyone. No handphones during the exams. All right, and I've also uploaded the link to the 2 competitions, the EY competitions and the Deloitte competition. All right, guys, now I do understand that EY competition is an individual competition. All right, I do understand that, but as a way to help you all out, this is my suggestion to you all. You all have your own assignment groups. Work out the case answer as an assignment as your whole group, but each of you all just do the presentation video individually. That means when you all are working out the answer, work it out as a group, submit the report. I know you need to submit the report, so all of you all can submit the same report. Each group can submit the same report, but do that 5 minutes, is it 5 or 15 minutes presentation video, each of you all do individually and submit it. All right? Give me the acknowledgement, I will give you all the marks. Guys, I know you guys are doing this just for the 5%, but like I said, put in a little effort. You never know, one of you all could be going to Germany. So do it with a little bit of effort in it. Do it with the belief that you guys can be the winner. All right? Now, if you guys need help, like what I put down there, feel free to come and ask me. Feel free to ask Miss Loges. Feel free to ask Miss Leong. All right? We are there to help you all with it. Okay, guys? All right. Okay, Ngam finished already. All right, let's look at taxability of income. Now, we said that income, as long as it falls under any 4 of that cases, any 4 of section 4, whether it's business, employment, dividend, 4A, 4B, 4C, 4D, 4E, and 4F, it becomes taxable. All right? Now, a lot of people ask me, what if I'm doing an illegal business? What if I'm a drug dealer? What if I'm not a drug dealer? Please don't go report me in. I said, what if I'm a drug dealer? Now, what if I'm a drug dealer? The first question Inland Revenue will ask me is, where are you selling your drugs? Malaysia, of course. Yeah. So did you derive an income in Malaysia? I guess so. I'm selling it in Malaysia, right? So I derived an income in Malaysia. Now, is it an income to you? Or is it a gain to you? Is it an income? Why are you selling drugs? You want money, right? Correct or not? So it's an income to you, right? Whatever the proceeds I'm getting from selling drugs is an income to me, right? It's not a, it's a business gain. A business gain is a business profit. So it's under 4A, correct? So it is an income to me. I did not sell a property. I did not sell shares. I did not get a capital gain. So it is a taxable income. It's revenue in nature. So it falls under Income Tax Act. So that Inland Revenue will tell me that I don't care whether it's legal or illegal. You got an income, and that income is in Malaysia. Therefore, you are taxable in Malaysia. Then I get other questions from my students. I'm surprised that no one has asked me this question yet, lah. But my other classes have, lah. Man, who's going to be so stupid enough to go and tell Inland Revenue they're selling drugs? Of course, lah. Even if I was selling drugs, I wouldn't be that stupid to go and tell Inland Revenue I'm selling drugs. But think about this. It's very common among Malaysians, lah. When you make money, what's the first thing you do? Spend money, right? How do you spend money? I want to buy a beautiful house, big house. I want to buy a flashy car. Nowadays, graduates come out also don't want Proton already. So the first thing you do is buy a luxury car. First thing you do is buy a beautiful house. You don't stay in the middle of jungle and sell drugs. So again, remember chapter 1, lifestyle. So when you live and spend money, Inland Revenue gets to know that you're spending money. So automatically they will start inquiring where you got the money to spend it. So when they find out that you got the money through an illegal nature, they are not worried. As long as it's an income, as long as it's derived in Malaysia, all illegal activities are subjected to tax. All right? All illegal activities are subjected to tax. Now, gambling. Remember just now I said, if it's a windfall, it's not taxable. So I say you buy a lottery ticket, you get winnings, it's not taxable. If I buy Impact Eco, if I win, it's not taxable. It is very subjective. When you talk about gambling, gambling is naturally not taxable if it's a windfall, but it becomes taxable gambling winnings. Gambling winnings becomes taxable. Becomes taxable when it's not a windfall. That means you do not subject it to luck. I do not believe in luck. So I want to win. All right? So when it's not subjected to a windfall, then that income or that winnings becomes taxable. Now, if it's done frequently, okay, I give you an example. All right? Say I'm a lecturer, I finish work at 5. 5:30 every day, I drive up to Genting's. Not for the food, not to the theme park, to the casino. I go to the casino, I gamble in the casino, and guys, this is just examples, okay? I do not do that in person. All right. I gamble until 12 o'clock and then I come back home, sleep, next morning come to Utah, lecture, go back, 5:30, leave again to go to. I do it on a daily basis, 7 days a week, 365 days a year. All right? So remember your badges of trade. When there is frequency, then it's deemed that I am having a business nature. Correct? So when there is frequency, then Inland Revenue says, you're doing it on a daily basis. How can you say it's windfall? You are making sure you're trying to get a winning. Okay? Now, I go to Genting's. I stand in front of the machine. I stare at the machine. I stare at the people playing the machine. And then I count. Every 10 times, after 10 times you pull the lever, you get a jackpot. You get not a jackpot, a strike. So I know that this machine now 9 times already. So I go and sit in the machine because I know the next one, for sure I'll strike a winning. So I keep doing that. Am I depending on luck now? No. I am ensuring my winnings. So I'm using my knowledge, I'm using the tools, I'm using probability rules to ensure the winning. So here I am ensuring my winning. So Inland Revenue said, then it's no more windfall, it's no more luck. You are making sure you get a winning. All right? Now, use of systematic means. Like I said, I count how many times. All right? Study of patterns. I was told by a friend of mine that even on the cards table, this can happen. Anyone want to go try it out? Only source of income. Now say I do not have my job as a lecturer. Morning 9 o'clock, I get up at 7 o'clock, have breakfast, 9 o'clock, I'm in Genting's until 5 o'clock. Whatever I win for the day is what I feed my family. If I don't win that day, too bad, my family starves. All right? So if that gambling winnings is your only source of income, then that source will come under section 4A or 4F. It will be taxable. It will be taxable. Now, gambling winnings will not be taxable. Gambling winnings will not be taxable if it is a windfall. So if it is luck, you buy lottery ticket, you're lucky, you win, then it's not taxable. You have no control over the winnings. You have no control over the winnings, it becomes non-taxable. You do it as a pastime. It's not your source of income. Then it is not taxable. All right? Hobby. Is hobbies taxable? Is hobbies taxable? Usually not taxable. Okay, example, I love to do gardening. So every evening, without fail, if it doesn't rain, I will be out in my garden doing gardening. Now, when I do gardening and then my plants grows really well, my neighbors say, hey, you have some beautiful plants, can I have one? I give it to them. That's not taxable. because it's my hobby. However, I love gardening, and of course I'm doing it frequently. I do it every day. Doing gardening frequently does not mean it becomes taxable. However, I do it with an intention. I do it with an intention to obtain a gain. All right. If I do it with the intention to obtain a gain, that means I do gardening. I fertilize my plants. I spend money on my plants because I want to resell my plants. So my intention to do gardening is no longer a hobby, although I like doing it. My intention is actually to nurture my plants to sell it. Then this could mean that income can be taxable. Even though it's in kind and not in cash, it can be subjected to tax. All right? Okay, guys? Any question? Withdrawal of inventory. I think you guys studied this. Majority of this you would have studied in text too. All right? Withdrawal of inventory. Now, it falls under section 24, subsection 2. Now, withdrawal of inventory usually for personal use. Usually this withdrawal is for personal use. All right? Now, Inland Revenue says that I know you took the inventory for yourself, but if the inventory was in hand, Inland Revenue says this. If the inventory was there, you would have sold this inventory and got an income. But because you took it for yourself, now you deprived yourself from getting the income. You stopped yourself from getting the income. All right? Example. Say I am running a grocery shop. All right? I'm running a mini market. Then my mother calls me. Nothing to cook for dinner. When you're coming back, please bring 10 eggs. So I put 10 eggs in a plastic and take it back. Now, do you think I'm going to put $5 in the... Not $5, okay, example, you think I'm going to put $5 in the cash register? Obviously not, right? It's my own shop. I'm taking back 10 eggs. Now, Inland Revenue says, if that 10 eggs was there, tomorrow morning, someone else would have come and bought that 10 eggs and would have given you $5 and you would have got $5 income, correct? But because you took back the 10 eggs, now you lost that $5 income. So Inland Revenue says the eggs was meant to be resold Because you chose not to resell it, now we take it that you derived, you got that $5 income. Although you physically did not put $5 in there, Inland Revenue takes it as if the $5 was earned. Do you understand or not? I know it's lunchtime. Now, any transfer from inventory to fixed asset any transfer from inventory to fixed asset is also considered withdrawal of stock. Huh? All right, it's also deemed sales has taken place. So when sold, when it's sold, it's deemed sales took place. The value will be taken at market value. All right. Now the most famous case is this. Go look it up, guys. Mercedes-Benz. Now what happened in Mercedes-Benz is, you know, whenever a model comes in, a new model comes in, they will put one model in the showroom, right, for people to come and see. So what Mercedes-Benz did is, when they put the model in the showroom, they, aside from taking it as a test run, they use it to run errands in the office. People want to go to the post office, I use a showroom car. People want to go to the shop to get something, I use a showroom car. So what they do is, they classify this showroom cars as fixed assets. Then after the new model comes in, another model comes in, they sell this. Because they classify it as fixed asset, any gains is considered capital gains and not subjected to tax. So after some time, Inland Revenue says, this is not right. When you bring in that car, although you put it as a showroom car, it's your inventory. You brought in 10 cars are meant for resale. So Inland Revenue took it up to court and said that is actually revenue in nature, should be taxed. Then it went ding dong, all the way up to federal court. Federal court deemed that it is revenue in nature. Mercedes-Benz had to pay the outstanding tax. It's a very nice case, go look at it. All right, any question, guys? Now, like I said, I'm going very fast in this. If guys don't understand, go look up your text 2 notes. I guarantee you it's all in your text 2 notes. Okay. Loan from bank. Waiver. Waiver of loan from bank. Hold on, guys. I just put waiver of debts first.
Then I talk about banks.
Okay, waiver of debts. Section 30, subsection 4. Waiver of debts. Okay? So when you're talking about waiver of debts, you're talking about your haircut. Not your haircut lah, it's called a haircut. Alright? So, section 34A. Section 34A. Here is when trade creditors waive debts for purchases made. This section talks about trade creditors waiving waivers all right. So the first thing you need to understand is this. Say in the period 2022, all right, purchases were made. In this period, purchases were made. So in 2022, purchases was a deductible expense. Purchase was a deductible expense, correct? Because it was considered goods sold. These purchases would have been cost of goods sold. All right, now say in 2023, your company went through a lot of problems. So now, creditor says no need to pay the debt. Creditor is such a nice person. Says, never mind, I understand that you're going through a lot of problems. No need to pay the debts. All right. So that means the loan is waived here. The debt is waived. The debt is waived in 2023. Correct? Now, Inland Revenue, did they give you a deduction in 2022? They gave you a deduction in 2022, correct? So in 2023, amount will be taxable in 2023 since debt waived Inland Revenue says because you don't need to pay your creditor, you have saved say $1,000. Because you don't need to pay your creditor $1,000, you have now saved $1,000. Am I right? When you save that $1,000, is it more money for you to spend on other things? So it's an income to you. All right? So therefore you will be taxable on it. Now, bank loan. Bank loan waiver. All right? Now, capital waived is considered not an income. Therefore, not taxable. So the capital portion of the loan is not considered taxable. Now, interest, on the other hand, is different. All right? Now, interest is a deductible expense in the period it is accrued. It's deductible in the period it is accrued. All right? Now, example 2020 to 2022, interest not paid. Interest is not paid, but accrued in the accounts. Interest was not paid, all right, for the loan, but it was accrued in the accounts. This interest would be a deductible expense in 2020, 2021, and 2022. So for all the 3 years, it will be a deductible expense. Now say in 2023, interest was waived. Interest was waived. In 2023, interest was waived. the amount of interest that was waived whatever interest that was waived would be subjected as an income. Why? Because I gave you a deduction earlier. So now that I'm waiving the interest, it becomes a taxable income. All right? Question, guys? Compensation. Of loss of assets. Compensation on loss of assets. All right? Now, when you lose an asset, the first thing that you need to understand is this asset generating revenue for you? That means it helps you to generate revenue, or is this asset itself a revenue generator? All right? Okay, let me explain to you all this. Now, say I have a warehouse. Say I have a warehouse, all right? In my warehouse, there are shelves for me to arrange my inventory, all right? My warehouse itself is my asset. Inside the warehouse, there's shelves. On the shelves are my inventory. On the shelves are my inventory. Now, say my warehouse got burned down, all right? Everything in there perished. The warehouse also burned down. The shelves also burned down. The inventory burned down. All right? Say now I got a compensation of $1 million. I got a compensation of $1 million. Out of this $1 million, they say that 400,000 is because of my inventory. 400,000 is because of my inventory. Another 600,000 is for my warehouse and shelf. All right? Now, Inland Revenue says, this $400 that you received, $400,000 that you received. All right? This 400,000 that you received. Now, if you had the inventory, what would you have done? I would have resold my inventory and got a gain. That gain would be under 4A, correct? Business profit. So if it's under business profit, it's a taxable income under Income Tax Act, because my source is 4A. Am I right? All right. So Inland Revenue says, whenever you get a compensation, and that compensation is regarded to be your trading inventory or trading stock, then this is a revenue generator. It generates revenue for you. So your inventory is your revenue generator. All right. So if you had the inventory in hand, you will sell it. Sorry. I forgot to silence my listing. Sell it and generate profit. You would have sold it and generated profit. So the compensation is to fill the temporary hole in your revenue generation. There was a hole because your inventory burned down and you couldn't sell that inventory until you got new inventory. So it created a damp, a hole in your revenue. This compensation, when it came up, it filled up the hole already. Correct or not? All right. So the compensation was merely to make good the profit loss. Just to make good the profit that you have lost. Now, on the other side, my 600,000 is a capital gain. Why? Because there is a permanent loss. There is a permanent loss. All right? It affects the business structure. Now, if I lose my inventory, I can replenish my inventory and carry on my business. But if I burn down if my whole shop gets burned down, I cannot run down, even if I have the inventory, I cannot run my business. For example, if I'm running a restaurant, right? I cannot open my business because I got nowhere to serve my food. Correct or not? So this now puts a closure on my business structure itself. I can't move forward. Understand or not? If I lose my inventory, I can buy my inventory tomorrow. For example, if I have a restaurant, my kitchen, say all my noodles got burnt. I got no more noodles. So I can still run up to the shop, buy noodles, and I still can serve. But if my whole kitchen burns down, I cannot cook noodles. Even if I have noodles there, I cannot cook noodles. I cannot serve my noodles because I got no kitchen to serve it, to cook it. So that becomes this damper or a stop on my whole business structure. So my business cannot carry on. Here, business cannot carry on. So if that happens, then it becomes a permanent effect. So this becomes a permanent hole. So until I restructure, build back my restaurant, I need to close down my restaurant. So this compensation that I am getting is to replenish not my income, but is to replenish my asset. Therefore, it's not taxable. Because it's a capital gain. Any revenue gain is taxable. Even if I rebuild my warehouse, I'm not going to sell it. So whatever compensation I got was to make good the capital asset I lost. Therefore, it's not taxable. All right, guys? Okay. Yes? You want me to carry on? You ask the permission to. Did you ask me the life of a person? All right, guys, we'll stop here now. We will continue next week. Oh yeah, revenue gain is taxable. Oh, I forgot to tell you all that. Yes, revenue gain is taxable. So this 400,000 is taxable. Hi.